Hey, what's good, y'all? It's C. Will, and this is the Passive Income Network. On this podcast, we talk about investing in assets that produce passive income. Make sure you hit that like button, subscribe, and leave a comment and say what's good. On this episode, we'll be focused on the stock market and options trading in general. So we'll have special guest Simon Reed back on the show. Welcome, Simon.
Hey, Sue. Will, great to be back.
Yes, great to have you on. It was an explosive episode last time, so I had to bring you back.
Awesome. No, thanks for having me.
For sure. So can we start off with an introduction, reintroduce the audience to who you are and a little bit on your background?
Yeah, sure. So I've been fascinated by the stock market in particular since I was in my late teens. I was in my second last year of high school when the 1987 stock market crash hit, and that whole process just fascinated me. And I had a really good economics teacher at school who kind of fostered my interest. And I really came out of that episode. I didn't have any money invested, so it was all just purely for interest. I thought, yeah, I want to do something in the stock market one day. I studied economics and finance at university, and my first job out of university was as a futures broker. And that was cool, right? I got to learn about markets and charts and technical analysis and all of that sort of stuff. But somehow I didn't find frozen orange juice and pork bellies as interesting or as dynamic as, Microsoft or, any of these upcoming tech companies as they were back then. So I still wanted to get into the stock market, and I made that transition back in 1996. Started working for Goldman, and I built a business in their equity derivatives business because I had a good derivatives background from my days trading futures. And I had just a natural passion for the stock market. And so, one thing led to another. I founded and ran the markets desk for Goldman Sachs in Sydney between 2005, 2010. And then in 2010, Citibank in Singapore headhunted me to come up and join their team in Singapore. And I spent the next 6.5 years there consulting to and working with some of the wealthiest billionaires and family offices right across Asia. And I left the corporate world in 2017, and I just felt a bit hollow. I'd spent my whole career really just helping people who'd already made it financially kind of stay rich or get even richer. And I thought, well, how can I put my skill set to use helping people who really need this information as to people who don't kind of really need it. And so I wrote a book. I wrote a book called The Tao of Trading. I set up an online education business, also called The Tao of Trading. And my mission ever since has been to help people learn how to trade options for themselves, decode the markets, navigate the markets successfully and profitably so that they can grow their wealth far more quickly than through conventional means.
Makes sense. Thank you again for that. We looking at, options and trading. It does, like after I read your book, so thank you for that gift there, and started dabbling myself. And I do see the possibilities that trading options does have. And like you said, it is a little fun trading some of your favorite tech companies as well. Futures. Can we just talk about futures a little bit? Can you do
sure.
a short breakdown of what exactly futures are for the audience? Because that's a term that a lot of people I know don't understand.
Yeah, so a futures contract is an agreement or a promise to buy or sell a fixed quantity of a certain asset, and that can be a physical asset like gold or coffee or orange juice, or it can be a financial asset like the S&P 500 or the NASDAQ or 10-year treasuries. But it's a promise to buy a fixed quantity or sell a fixed quantity if you sell futures at a specific price at a future date. And so the main players in futures markets are those who want to hedge and those who want to speculate. So if you think about a gold producer or a wheat farmer, they would be interested in potentially selling futures contracts in gold or wheat respectively to get some certainty over what sort of price they're going to get. So if you're a gold miner and you've got a bunch of gold loans to banks to fund your cost of mining, you might want to lock in a minimum price for your gold. And one way of doing that would be by selling gold forward. Similarly, if you're a wheat farmer, you may just want to sell enough wheat forward to ensure that you can cover your plant and equipment and machinery and wages and that sort of thing. And, you might take some market risk on the rest of your wheat, but it's a way of just ensuring you're reducing the volatility of your cash flow and your income. And then, of course, speculators are essential on the other side of those trades, because you need somebody to take the buy side of the trade, and that could be somebody who's bullish wheat or bullish gold, or for whatever reason. They're just two examples.
Excellent.
Yeah, so that's kind of how it came about and how it works in a very simple sense.
Yeah, I was looking at futures recently, and I saw orange juice was going crazy. Seems like all year. I thought that was interesting. When I went to the store, I could see it reflected in the price.
Right, there you go.
Yeah, it's kind of funny. All right, so current state of the market, right? There's a few things that has been happening. So August, a lot of stocks have, been on a downtrend, and then that seems to be continuing this month. Historically, September has been a lot of a downside there, and we have high interest rates. Can you speak on kind of the current state of this market and what you're seeing?
I can give you my opinion. So
yes, your opinion.
As you said, September is historically, it's actually the worst month of the year for the market. It's the only month that on average has a negative return. And it's kind of living up to that promise at the moment. Now, we're in a situation where markets, we had that kind of mini regional banking crisis in March, and everybody kind of got a bit scared. Since between March and August, the markets were just on a tear. And I think what happened was, if you wind the clock back 12 months, so the equity markets bottomed in October 2022.
Yep.
And pretty much everyone, all of the experts, all the economists were forecasting a recession to hit in the early part of 2023. And it didn't happen, and it didn't happen, and it didn't happen. And so I think we had relief, waves and waves of relief about how resilient the economy was, how resilient unemployment was. Labor markets have been really strong, and how resilient the consumer was. And it's got to the point now where all of the people who were kind of eagerly looking for a recession 12 months ago have thrown in the towel and gone, we'll get a soft landing. And I think what happened was, the Fed raised interest rates from 0 to 5.25%, 5.5% in the space of less than 18 months. It was the most aggressive rate of interest rate hikes that we've seen in more than 4 decades since, the Volcker days. And it's almost unprecedented to see that kind of rapidity in rate hikes. And historically, whenever we've seen the Fed hike rates to that extent, it has resulted in a recession.
Yep.
And so I think that people thought a recession was teed up and it was going to happen because of interest rates. What people, I think, didn't factor in, though, was, we had an unprecedented, or almost unprecedented rise in rates. What was truly unprecedented was the amount of fiscal stimulus and government spending that came in post-COVID. There was, I think, $5.6 trillion worth of fiscal stimulus through various acts from 2020. And that included $2.2 billion that went straight into the hands of American consumers through the CARES Act. Now, you can't spend $2 trillion all at once, right? It takes time for that sort of money to work its way through the economy. But from what I'm reading and what I'm hearing at the moment, it looks like that 2.2 trillion is pretty close to running out. We're already seeing consumer credit card debt levels and delinquency levels are back at 2008 levels, which doesn't sound great. Nope. Banks are certainly rationing credit. Credit is becoming less available. And these historically have been parts of the early sequences of a recession. We've also seen things like ISM new orders. It's seen as a leading indicator. That has been in contraction for 10 months in a row. And whilst the economy has been adding jobs this year, the more cyclical components like transport and more recently manufacturing have been losing jobs. That can also be a bit of a recessionary warning. The other recessionary warning is the fact that non-farm payrolls, even though they have been additive this year, we've had 7 months in a row of downward revisions. So that is also a warning. So I don't think we're out of the woods yet, Sue. Well, I think a recession is still likely in the next 3 to 6 months. and I don't think the market is priced for that. I think if we do get a recession, the S&P could easily be 15-20% lower than it is now.
Yeah, we can definitely see that happen. This market is going crazy right now. So you said transport's down, manufacturing is down.
Oh, employment, yeah,
Excuse
employment in
me,
those sectors,
employment in
yeah.
those sectors.
But
Yeah,
the transport sector has been hit hard as well.
yeah,
Yeah, yeah,
yeah. And it's
you're dead
very
right.
interesting with even the lot of the what's it protests or strikes, excuse me, that are
Strikes.
going on right now with GM and Ford. And I see there's a battle going on between the employers now are also firing people. So I think that's going to continue and get more interesting. Um, so so the current state overall, it looks like what September has shown what it's supposed to do is kind of go down, and it is following trend there. So can we talk about identifying sectors to trade? So for myself, I've been looking for my understanding of people I've studied. It says like when interest rates are high, kind of look towards energy, and that's what I'm slowly doing now. And I'm noticing oil is on the uptrend. Can you talk about some of the sectors or different metrics you are looking at to find
Yeah.
some? As Kramer said, there's a bull market somewhere.
Yeah, absolutely, and you're spot on, Sue. Well, the bull market has been energy the last few months. That has certainly been the most bullish sector over the last 3 months at least. It looks like it's due for a little bit of a pullback here, but it's certainly looking more bullish than most other sectors. The other sector that still looks pretty okay is communications. This is stocks like Google and Meta and your
Makes
gaming
sense.
stocks and Netflix. I mean, Netflix doesn't look so good, but that sector looks like it's probably due for a bit of a pullback as well. The real excitement really has been in semiconductors and AI stocks, and
Yep.
Nvidia has been a big part of that. But even Nvidia has pulled back, and the thing is, as an options trader, I'll kind of trade anything because I don't need a bull market. I'll trade rising prices and I'll trade falling prices. So I'm not always looking for kind of the next hot sector that's going to go up. I'm also looking for sectors that are due for a pullback, and tech's the big one. Tech has been such a strong performer. It's tech and semiconductors have both been pulling back. So I've been playing them to the downside. I have been playing energy to the long side, but really I'm just looking for movement. I'm just looking for volatility up or down, rather than looking for a sector to kind of put my money in for the long term, because I'm an options trader. My default position is cash. And what I'm really looking for is setups. I'm looking for technical setups that I can take that give me an edge. Now, most of the time, stock prices are random, right? It's very hard to make sense of them. But there are specific moments in time where a stock price becomes relatively more predictable. That is to say, the probability of A happening is more probable than other outcomes. Now, there's no certainties here. We're always dealing with probabilities, but that's what I'm always looking for, technical setups that give me the probabilities in my favor. And that can be on rising prices or on falling prices.
Makes sense. Okay. So technical setups. And then this is when we're talking about indicators, or we're talking about
That's right.
so indicators. Is there a few favorite indicators? From my understanding, I know you like to trade off the day charts, right?
That's
Is there
right. Yep.
you have some other indicators or things you could present to the audience and talk about?
Yeah, sure. So moving averages are great because they're simple. They've been tested by academics to be statistically significant, and they can provide really clear, intuitive, powerful visual clues. Now, some people think, it's too simple. How can something like that work? The thing is, we're drawn to complexity as human beings, but very often simpler is better when it comes to trading. So one of the things I look for is a term that I call rainbow logic. And I use a series of moving averages. And the moving averages I use are the 8-day exponential moving average, or EMA, the 21 EMA, the 34 EMA, and then I look at the 50-day simple moving average, the 100-day simple moving average, and the 200-day simple moving average. And I color code them in the colors of the rainbow. So the 8 EMA is red, the 21 EMA is orange, the 34 EMA is yellow, the 50 SMA is green, the 100 SMA is dark blue or indigo, and the 200 SMA is, violet or purple. And what happens on my charts is when I see those moving averages lined up in the colors of the rainbow, I know I've got a strong trend, whether it's up or down. And that's why I call it rainbow logic. When I see the rainbows on my chart, I know I've got a strong trend that I can potentially exploit.
Makes a lot of sense. Yes. Rainbow logic. Make sure y'all take notes on that one. Good information there. EMAs, SMAs. So the difference, is there a big difference between the SMA and the simple moving average and the exponential moving?
Yeah, there is. So an exponential moving average will track price action more closely. So it will moving averages smooth price action out. An exponential moving average, though, will be more responsive to price. It will track it more closely. So they are very good at identifying short-term trends. Simple moving averages will track price action more slowly, and they're really good. I mean, they're good for identifying longer-term trends, but they're also good for identifying potential areas of support and resistance. Because you'll often find a stock, if it's in an uptrend but it's pulling back, it'll often find support at that 50-day simple moving average. And if it closes below the 50-day simple moving average, that's a bearish warning. I will stop taking long trades on a stock if it falls below its 50 moving average. The 200-day moving average is often regarded as the line in the sand between a bull market and a bear market, or a long-term uptrend or a long-term downtrend. I often call the 200-day moving average, it's like the market's Jekyll and Hyde switch. Yep. Because it seems to undergo a personality shift when it crosses it. So, if the S&P 500 is trading above its 200-day moving average, it's generally happy or bored. If the S&P 500 is trading below its 200-day moving average, it's usually anxious and fast and a little bit scary and jittery, and it tends to be a lot more volatile.
That does make sense. That 200 is very important, and it does. When I do some back testing, I like to go back and look at what was kind of happening during COVID, and you can see a lot of those actions, happen rapidly, and then led to a downtrend, and reversed eventually.
Absolutely, yeah.
So let's talk a little bit about winners and losers, right? This is something that I personally struggle with. Like when a stock is going down, or option play, better yet, do you have certain percentages or I guess maybe numbers that you do to know, like signal yourself to cut? Or in the other side, what about taking profit?
Absolutely. So, I've written a trading plan, and I think anybody who is even half serious about trading owes it to themselves to write a trading plan before they start. All right. And this is how you bring, consciousness to your trading in the heat of the moment. Because when you're trading and things start to go not according to plan, you can feel anxious, you can feel emotional. And when the emotional brain is running the show, your ability to make high quality decisions is compromised. All right. Stress literally makes us stupid. But if you've written down a trading plan that's thoughtful, and you've brought your consciousness to it in the cold light of day, you'll always know what to do when you're kind of feeling the heat of battle. People often say, "Oh, I bought this stock and it's gone down. What should I do?" And usually my first response will be, "Well, what does your trading plan say that you should do?"
Yep.
And that's when they start floundering and they go, "Oh, what do what's that? What's a trading plan?" Right. So I make sure all of my members, I get my template. I teach them how to write a trading plan, because I think that is crucial to success. So I'll just share with you some snippets of my risk management from that. So I have what I call my OMG stop loss level. And that is if an option I've bought declines by 50% in value, I will cut it no matter what. At that point, hope doesn't cut it. You've probably heard the saying, hope is not an investment strategy. If you're down 50%, hoping that things turn around, you're gone. All right, just get out of that position and move along. What I try and do, though, is cut a position long before it gets there. And I always say I need 3 or 4 reasons to get into a position. I only need 1 reason to get out of a position. So if anything happens that doesn't smell right, makes me uncomfortable, is unexpected, I'll cut it. And if the stock eventually ends up doing what I expected initially, I can always get back in. All right. Brokerage charges these days are so low, or in some cases they're zero. If you're paying a dollar a side brokerage, it's not an impediment to
No.
getting out and getting back in if that's what you want to do. But there's an old saying: I'd rather be out of a position wishing I was in than in a position wishing I was out. All right, because you can kick yourself if you see something fly away without you. But I'd much rather do that than be hemorrhaging real dollars in something that is causing me damage. What you
Yeah.
don't own can't hurt you. So if anything happens that is unexpected, I will get out. So that might be, the 8 EMA crossing under the 21 EMA. If that happens, generally I'll just cut the position. As I said earlier, if price closes below the 50-day simple moving average, the 50 SMA, generally I will just get out of the position, and that these types of techniques will get me out of a position much sooner than if I'm just hanging around waiting for my OMG stop loss level to be hit. In terms of taking profit, there's a couple of things to bear in mind. I'm always conscious of what my average loss is. All right. If my average loss is sitting at, say, 25%, I know I really want to be hitting winners at least 50%. So that way I'm maintaining a 2-to-1 risk reward ratio. So I'm always calculating what my average losses are like. And I'm always trying to make at least 2-to-1 risk reward. But then I'm obviously making sure that that's realistic. And I'm looking at things like support and resistance. How far can this stock run before it runs into a wall of support? And if I've got no chance of making my target return before that happens, I won't take the trade. Also, things like I'll use things like average true range. I'll usually take profit on a stock if it gets to, say, 2 to 3 average true ranges above its 21 EMA, because usually that's when a stock will start to revert back to the EMA. An uptrend, stocks don't hardly ever move in a straight line, right? They move in wiggles. And what I want to do is try and sell near the top of that wiggle and potentially buy it back on the wiggle back down, that little pullback or retracement. So it's really important, I think, to manage that downside risk first, and depending on what that looks like will be how I think about setting my profit targets.
Oh, this is some great information. So thank you. It does make a lot of sense. You said like the 2 versus 1 ratio,
as a minimum. Yeah.
As a minimum. Yeah. That makes a lot of sense. Cutting the stocks when you got your indicators that that you need to get out, which is following your trading plan. You're sticking to what the information that you have created when you were clear. And that makes a lot of sense. I like that. So when it comes to day trade, I want to talk about that a little bit. Do you day trade, or do you have an opinion on day trading versus the way that you're trading?
Day trading is, I think it's more difficult. Right? When you get down to smaller time frames, all of a sudden you're facing different competition. All right, and I'm talking about algos that JP Morgan have spent hundreds of millions of dollars developing. All right, that they are starting to become your competition when you're trading very small time frames. So day trading, I think, is more challenging. Doing what I do, which is trading options, my average holding period is anything from 2 or 3 days to 2 or 3 weeks. It's not really a happy hunting ground for algos. That they're either focused on the really short-term stuff or the much longer-term stuff. That sort of medium-term stuff in a trading sense is not really kind of algo-dominated, at least not yet. So I think day trading becomes more challenging in that regard. The other thing is it's a personality thing. I like to sit and plan my trades when the markets are closed and I got a cup of coffee and I'm very relaxed and unemotional. I don't like having to make split-second decisions when numbers are flashing at me and there's red arrows and green arrows, and I just find that a bit stressful. And I find that the quality of my decision making is lower.
Yeah, I agree. I dabbled with some day trading. I was my anxiety was really high, and I was like, very stressful. But I know there's some profitable ones out there. So
Yeah,
Shout out to them.
I'm not talking anyone out of doing it, but do your homework and
Yeah,
practice, because it's not easy.
yeah, yeah. That's been my experience.
Yeah.
Okay, so as we slowly start to close out, can we talk about some best practices that you like, or some pointers you have for just improving your trading, whether that's some mental psychology, or as you said, working on your trading plan, or anything
Yeah.
of that nature?
Working on your trading plan is fundamental. A trading plan, it's an ironclad document between yourself and you that you'll follow no matter what. All right. And I aim for 100% compliance with my trading plan.
Mm.
I probably get to about 95%. All right. I'm only
Solid.
human. I do bend the rules occasionally.
Nice.
And 9 times out of 10, I kick myself for doing it. The
Mhm.
trading plan is there to keep you safe. In terms of improving your trading, and again, this goes back to risk management, the low-hanging fruit is managing your losses better. All right.
Mm.
Stopping your number one job as a trader is not to be right.
Mm.
Okay. It is to stop a small loss from becoming a big loss. And if you can get really good at that, getting ruthless on trades that are stealing money out of your account, sacking them as quickly as you can, your account will love you for it. And it made a big difference to me. Cutting a trade at a 25 to 30% loss rather than a 50% loss is actually really, really easy to do.
Mhm.
All right. As soon as you get over that kind of ego thing of, oh, I'm wrong, it's really easy to do. Try to max out your winners, like trying to squeeze, 120% gain out of a trade instead of a 100% gain is much, much harder.
Mm.
All right. So, and a lot of people think, well, I've got to max out my win rate. I've got to be winning 80% of my trades, 90% of my trades. The problem is most trading methods that have a really high win rate have a really ugly risk to reward.
Mhm.
The old saying, you're picking up pennies in front of a steamroller. It can often look a bit like that. Your winners are regular. You're ringing that cash register often, but every now and then you have a big loss that comes along and it sort of undoes your last 8 or 10 winning trades.
Yep.
And so your account can grow over time, but it does it in a very sawtooth manner, which can be, that can be kind of demoralizing, not that much fun. Winning is fun, but if you're winning small and you have a big loser come along that wipes out a lot of winners, it's like, oh man.
Yeah,
So
that hurts.
I aim for a modest win ratio of about 60%, and my average risk reward is about 2.7 to 1. And if you can hit numbers like that, you can make a really good living from trading.
Yeah, it makes sense. That sounds great. So is there anything else you would like to share? And I know you have workshops and books and different products that I know would bring value to my audience. Could you talk about anything you have coming up that people could join?
Yeah, look, what I'd like to do, C. Will, is invite your members to hit a welcome page. It's taoftrading.com/CWill. So that's taoftrading.com/CWill. And any of your listeners can hit us up for a big discount on one of our highly rated trading programs.
Excellent. That sounds great. I'll make sure I have that link in the description so that anyone's interested can go join up. Thank you again, Simon. This has been
It's
great.
been an absolute pleasure. Always a pleasure, C. Will. Thank you.
Thank you. All right, Simon, until the next time, I'm going to go say bye to my audience and just wait a moment backstage, and I'll talk to you in a second.
Sounds great.
Thank you. Hey, y'all. So that was Simon Ree, came back on the Passive Income Network to talk about options trading, the stock market, and give some opinions on what he sees in the market, and then some things on information of how we can all improve our trading and our strategies of making money out of this stock market here. So thank you guys all for watching. Make sure you leave any comments, suggestions below. Look out for that link in the description. And until the next video, y'all, I'm gone.